You hear it all the time, right? On the news, from politicians. By every official measure, the economy seems to be doing just fine. Unemployment is supposedly low. The job market is strong. GDP is growing. But if all of that is actually true, then why does it feel like everything is falling apart?
And that is the massive question at the heart of this explainer. What if the story the numbers are telling us isn't the whole story? What if the recession everyone is bracing for isn't some distant storm on the horizon, but it's already here and we just haven't been officially told yet?
Okay, let's just break this down. On one side, you've got the official story, painting this picture of a really robust, healthy economy. And on the other side, well, you have the reality that millions of us are living every single day. A reality where everything feels completely unaffordable, and financial security just seems to slip further and further away. This isn't just a feeling, you know? It's a massive disconnect between the data we're shown and the lives we're actually leading. So what is really going on here?
To figure out what's happening right now, we actually need to take a quick look back, because the first clue to solving this puzzle is understanding one simple but absolutely critical fact. Official recession announcements, they aren't breaking news. They're history reports.
That's right. The official group in the US that calls a recession the NBER, they always do it looking in the rearview mirror. They have to wait for all the data to come in, for it to be confirmed and double-checked, and what that means is they're telling you about a storm you've already lived through, not one that's on its way.
I mean, just look at the 2008 financial crisis. It's the perfect and honestly a pretty scary example. The recession technically started in December of 2007, but the official announcement, that didn't come until December 2008, a full 12 months later. By then, Lehman Brothers had already collapsed. The entire global economy was in an absolute freefall. The announcement was just confirming a disaster that millions of people were already painfully aware of.
So, if we can't trust the official declaration to be on time, what are the real-time signals we should be paying attention to? Well, let's start with the one we hear about the most, the job market and that big headline unemployment number.
So you see a number like 4.4% unemployment, and on the surface, that doesn't sound so bad, does it? It's the kind of number that gets celebrated on the news as a clear sign of a strong, healthy labor market. But this number, it's hiding a pretty big secret.
And here is the crucial detail. To be officially counted as unemployed, you have to have been actively applying for jobs within the last 4 weeks. If you're too discouraged to look, or you've given up, or you've had to drop out to take care of family, you don't exist in that statistic. And you might be wondering, okay, but how many people could that possibly be?
1.6 million. That's how many Americans have just stopped looking for work since the pandemic. They're not counted as unemployed. They've just vanished from the data. It's a silent crisis, totally hidden behind a number that's supposed to look healthy.
Now here's where the job growth number can become a total illusion. Picture this, a full-time worker, salary, benefits, the whole deal, they get laid off. Now, to scrape by, they're forced to take 2 part-time, low-wage jobs. For that person, it's a devastating blow to their income and their stability. But in the official data, you know what that looks like? A net gain of 1 job. It's accounting magic, and it completely masks a really serious decline in the quality of jobs.
And look, this isn't just some hypothetical. Right now, there are 4.4 million Americans working part-time, not because they want to, but because they simply cannot find a full-time position. They're technically employed, sure, but they're living on the edge, usually without benefits and with 0 long-term security. And of course, this weakening of the job market hits people right where it hurts the most, their wallets. Which brings us to the next huge warning sign, the incredible, immense pressure building on the American household. Since 2020, prices have gone up by over 25%. Think about that. That's a direct, punishing tax on every single dollar you earn. Your paycheck might say the same number, but its actual power, its ability to buy gas, to buy groceries, to pay your rent, has been absolutely hammered. So how are people supposed to cope? How are they filling that gap? Well, they're turning to what I can only call plastic poison. Total credit card debt in America has exploded to a record $1.28 trillion. People aren't just swiping for little luxuries anymore. They are borrowing money at 22% interest just to cover the basics.
And at the very same time, the safety net has been completely shredded. Historically, Americans saved about 8% of what they earned. Today, that personal savings rate has cratered to just 4.5%. We are spending more, we are borrowing more, and we are saving less. The cushion is gone.
And you have to understand, this pattern is not new. This is textbook pre-recession behavior.
You stretch households to the absolute breaking point with debt while their real income isn't going up. We've seen this movie before. It's the exact same script that played out in 2007, right before the entire system came crashing down.
So, this all leads to the really big question, right? If all of these warning signs are blinking red, why do the official numbers, the headlines, still look so good? The answer lies in this really powerful idea that explains the entire system's massive blind spot. It's something called Goodhart's law, and the idea is actually pretty simple, but it is so profound. It says that the very moment you make a number, a metric, the main target of policy, that number stops being a good way to measure reality. Because people just start gaming the number itself, not the real-world outcome it was supposed to track. And you see this everywhere. The target becomes low unemployment, not high-quality jobs with good pay. The target becomes GDP growth, even if that growth is just being fueled by a mountain of unsustainable debt, not by people actually earning more. The target becomes a managed inflation rate, not a lower cost of living for your family. The system learns how to make the numbers look good, even when reality is getting worse.
And over time, the numbers just drift further and further away from what everyday people are actually going through. We're not getting an honest picture of the economy's health anymore. We're just getting a report card on how well the numbers themselves are being managed.
And that gap, that space between the official numbers and the lived reality, that's exactly where recessions hide, until they're suddenly too big to ignore. So let's put it all together. Let's look at our own economic dashboard based on the real signals.
Think about it just like the dashboard in your car. The labor force is actually shrinking. The quality of jobs is getting worse. People's savings are disappearing while their debt is skyrocketing. And on top of it all, bankruptcies are at the highest level in over a decade. Now look, any one of those warning lights on its own could just be a flicker, a false alarm. But when they're all flashing bright red all at the same time, it means there's something deeply, fundamentally wrong with the engine.
You see, the real economy always leaves clues for anyone who's willing to look past the official headlines. All these signals, together, they form a pattern, and it's a pattern we've seen before. The only real question left is how long it's going to take for the official data to finally admit what's already happening. So when that day comes, when the numbers finally catch up to reality,
Who is going to be prepared and who is going to be blindsided?